You've probably seen headlines about everyday people turning a few $100s into crazy amounts by riding the crypto wave. Some hit the jackpot, selling at just the right moment. But what if I told you the biggest winners weren't those who caught the waves, but the people who built the tide itself? Today, we're diving deep into one of the most dramatic stories of the crypto era, the rise, collapse, and stunning legal reckoning of Sam Bankman-Fried, once celebrated as the king of crypto and now known for one of the biggest financial downfalls in modern history. This isn't just about numbers, it's about power, trust, risk, and one of the wildest chapters in digital finance. When people imagine a young billionaire, they picture luxury, confidence, and non-stop headlines. Sam Bankman-Fried didn't fit that image. He showed up to interviews in simple clothes, messy hair, and spoke in calm, analytical sentences. He didn't look like someone chasing fame, and that made him seem more trustworthy. Born in 1992 in Stanford, California, he grew up in a highly intellectual home. Both of his parents were law professors, so conversations about ethics and public responsibility were normal in his household. From an early age, Sam was drawn to logic, probability, and strategy-based games. He liked understanding systems, not just participating in them. At MIT, he majored in physics, one of the most demanding fields of study. Physics trains you to think in models, numbers, and outcomes. It forces you to calculate risk, something that would later define his career. But what truly shaped his ambition was his belief in effective altruism, the idea that the best way to help the world is to earn as much as possible and donate strategically. He didn't just want success, he wanted scale. And in his mind, the fastest way to scale impact was through finance. After MIT, Sam joined Jane Street Capital, one of the most advanced quantitative trading firms on Wall Street. Here, he wasn't casually investing. He was working in a high-speed, data-driven environment where millions, sometimes billions, moved based on mathematical models. Every trade was calculated. Every risk was measured. At Jane Street, Sam learned how liquidity works, how leverage multiplies outcomes, and how professional firms exploit tiny pricing inefficiencies across markets. Most importantly, he learned that markets aren't always perfectly efficient. Even in traditional finance, gaps appear, and those who move quickly can profit from them. So when crypto exploded in 2017, Sam didn't see hype or ideology. He saw inefficiency, he saw volatility, he saw opportunity, and that realization would lead him to build something much bigger than just a trading strategy. When Bitcoin exploded in 2017 and headlines were filled with stories of overnight millionaires, most people were focused on the excitement of rising prices. Sam, however, wasn't interested in hype or speculation about where crypto might go next. What caught his attention was something much more technical: price inefficiencies. He noticed that Bitcoin wasn't trading at the same value on every exchange around the world. In some regions, particularly in parts of Asia, the price was significantly higher than in the United States. That gap created an opportunity known as arbitrage, where a trader can buy an asset in one market at a lower price and sell it in another at a higher price, locking in relatively low-risk profit if executed correctly. Seeing this, Sam founded Alameda Research, a quantitative crypto trading firm built to exploit these gaps at scale. Alameda wasn't operating like casual retail investors, it functioned more like a Wall Street desk, moving large amounts of capital quickly between exchanges and relying heavily on data and speed. At its height, the firm was reportedly trading tens of millions of dollars in digital assets each day. Sam didn't promote bold predictions about Bitcoin's future or present himself as a crypto visionary. Instead, he positioned himself as a market strategist who understood how to profit from structural weaknesses. Alameda's rapid growth gave him both capital and credibility, but as he continued trading across different platforms, he began to see deeper flaws in the exchanges themselves, and that realization would push him towards something much bigger than trading alone. By 2019, cryptocurrency exchanges had become widely accessible, but most of them were designed primarily for beginners who simply wanted to buy and hold digital coins. While platforms like Coinbase made crypto purchasing simple and user-friendly, they lacked many of the advanced tools that serious traders expected. From Sam's perspective, these exchanges were inefficient, slow to innovate, and poorly structured for high-volume trading. Drawing from his experience at Jane Street and the operational challenges he observed while running Alameda, he launched FTX with a clear mission: build a platform tailored specifically for professional and active traders. FTX introduced complex products such as crypto futures, options, and leveraged tokens, offering users the ability to take sophisticated positions that weren't easily available elsewhere. The exchange emphasized speed, deep liquidity, and a wide range of trading instruments, positioning itself as a serious alternative to existing platforms. Initially, growth was modest because the broader crypto market was still recovering from its earlier crash, and enthusiasm had cooled significantly compared to 2017. However, Sam believed volatility, not hype, was the true engine of trading activity. As markets began heating up again in 2020 and 2021, FTX was perfectly positioned to capture that surge, and what followed was not gradual growth, but a dramatic expansion that would soon turn the company into one of the largest crypto exchanges in the world. As FTX gained momentum, one of its biggest advantages was leverage, a feature that allowed traders to control positions much larger than the cash they deposited. This meant small price movements could generate large returns, which made the platform extremely attractive to active and professional traders. FTX offered advanced products like perpetual futures and leveraged tokens, tools that weren't widely available on beginner-focused exchanges. During the massive crypto rally of 2020 and 2021, trading volume surged into the billions per day, and FTX quickly became one of the largest exchanges in the world. High activity meant high fee revenue, and Sam Bankman-Fried's net worth climbed rapidly, largely tied to his ownership stake in the exchange's native token, FTT. The company signed major sponsorship deals, expanded globally, and positioned itself as a serious player in financial innovation. Although FTX and Alameda Research were presented as separate companies, their financial connection was deeper than many realized. Alameda held large amounts of FTT, the token created by FTX, meaning much of its balance sheet depended on the value of an asset closely tied to the exchange itself. As long as market confidence remained strong, this structure appeared stable, but the system relied heavily on trust and liquidity. In late 2022, reports raised concerns about Alameda's financial exposure, triggering fear among investors and large account holders. Withdrawals from FTX accelerated rapidly, creating a digital version of a bank run. Billions of dollars were pulled from the platform in just days, and FTX did not have enough readily available assets to meet demand. The speed of the withdrawals exposed weaknesses in internal controls and liquidity management, revealing that the foundation beneath the fast-growing empire was far less solid than it appeared. In November 2022, FTX filed for bankruptcy, stunning the crypto industry and shaking confidence across global markets. Customer accounts were frozen, and billions of dollars became tied up in legal proceedings. Sam stepped down as CEO as new leadership moved in to assess the situation and begin recovery efforts. Investigations later highlighted major failures in risk management, corporate governance, and financial oversight. What had once been valued at tens of billions of dollars collapsed almost overnight, wiping out nearly all of Sam's personal wealth in the process. The downfall became one of the most dramatic reversals in modern finance and sparked intense debate about regulation, transparency, and accountability in the digital asset space. The story shifted from rapid innovation to a powerful warning about how quickly trust can disappear when systems are pushed beyond their limits. After the bankruptcy, legal action moved quickly. Sam Bankman-Fried was arrested and later brought to the United States to face multiple federal charges related to fraud and financial misconduct. The trial became one of the most closely watched financial cases in recent years, drawing global media attention and intense public scrutiny. Prosecutors argued that customer funds had been misused and that investors were misled about the financial relationship between FTX and Alameda Research. Former executives and insiders testified, painting a picture of weak oversight and risky internal decision-making at the highest levels of the company. In late 2023, Sam was found guilty on multiple counts and in 2024, he was sentenced to 25 years in federal prison. The verdict marked a dramatic turning point. The same person once seen as a visionary entrepreneur was now facing the consequences of one of the largest financial collapses in the digital asset era. The rise and fall of Sam Bankman-Fried is a story built on extremes. In just a few years, he went from a relatively unknown trader to one of the richest individuals in the world, running a platform that handled billions of dollars daily. His vision combined advanced finance, aggressive expansion, and the promise of doing good at scale. Yet when trust broke down, the system collapsed with astonishing speed. What once looked like unstoppable growth revealed structural weaknesses that couldn't survive pressure. This story isn't just about one person, it's about how modern financial systems operate in the digital age, how quickly confidence can shift, and how innovation must be matched with responsibility. The question now isn't just what happened, but what lessons will actually be learned from it. What do you think? Was this a failure of one individual or a warning sign for the entire industry? Let me know your thoughts below, and subscribe for more deep dives into the biggest financial stories shaping our world.